Another week, another bullish commentary from Tom Lee. Now with Tom Lee, it's pretty simple. You either love the guy or you do not, right? It's pretty simple. You might say, oh, he's a perma bull. He's always bullish even when the market goes down. He predicted that we're going to bounce back already in March. And look, we're already at the end of March and we're still not bouncing back. Although you might say that we have more bouncing back days in the last week than we did previously. But okay, I get the argument. But the thing with Tom Lee, unlike with Cathie Wood, for example, is that Tom actually provides data. So he tells his story, but he tells the story based on the data that he has and that we have actually. And if it doesn't make sense to you, then fine. But he shows you the data. It's like, okay, this has happened in the past. If we look at all these figures, if we take the average, we think that this might happen again. Just because it happens before doesn't mean it's going to happen again in the future. I think we can all agree on that. But if you look at the data, if you look at the story, if you listen to his arguments, you cannot say, oh, this guy is full of it. No, he makes a compelling story. Of course, in the short term, he can be wrong. I believe at the end of 2024, we talked about his projections for 2025. He said that first half of 2025 would actually be quite good. Second half, not so good. And I think right now we started the year quite well. But then since mid-February, things were going downhill a little bit. Of course, we still have 2 months left or so, a little bit more than that, to reach the first half of 2025. Things can change drastically. And I think after April 2nd, after we get that full list of tariffs and know exactly what's going to happen, that's when the uncertainties are going to disappear a bit. When the uncertainties disappear, I think the market will react way more positively. Now, of course, in the meantime, we have something like this. We have, again, health technology, consumer non-durables, and all of that. Those are always going to be green when we're going to see red with regards to technology. Big tech companies, likes of Nvidia, Broadcom, Meta still down. Tesla was actually, still up, and Tesla could be one of those stories. Look, Tesla right now, $273. Remember, 2 weeks ago, something like that, we were closer to $220. So is that already one of the first signs of, okay, maybe these types of beaten down stocks have found a couple of buyers and we are already seeing a little rebound happening? Could very well be. And so let's discuss this a little bit further. If you enjoy this type of videos, hit all the buttons. We really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, I first want to go back to what I mentioned a couple of videos ago with regards to macro news. So if you look at the past recessions, you can see that most of the times the stock market rebounds before the recession is over. Of course, you will only know about a recession after 2 consecutive quarters of negative GDP growth. But as history has shown us, again, history tells us something, you might learn from it, it might not happen again, but might resemble it, right? It often rhymes, as they say. We can clearly see that the market rebounds before the recession is over. By the way, if you're looking at egg prices here, they have really fallen off a cliff, over 60% or so, I believe, in the last month. So it's already quite good. Then, if we look at the first thing that Tom mentioned in his video yesterday, if you look at the money markets, if you look at the difference between a year ago and today, because a year ago and today, we're almost at the same level here when you look at S&P 500. Well, what is not at the same level is the money market funds. It's actually increased by $857 billion. So maybe when the uncertainties are over or have decreased, well, maybe we're going to see a lot of money flow into the market. Could very well be, because when you are uncertain, then you don't want to risk your capital. When uncertainties are disappearing, you might be risk on. And I think that's maybe what we might be seeing. The whole topic of his video was talking about a V-shaped recovery. We've seen past V-shaped recoveries, right? Remember, the start of the pandemic, 2020, March, huge crash, huge recovery, V-shaped like recoveries. Then if we look at margin debt, that has also started to decrease. We're still waiting for the number for March. But for the other 2 quarters, we can clearly see this starting to decrease. So this also can help with that V-shaped recovery. If we look at prime book percent of a total US net exposure, if you look at the Magnificent 7, which are the blue lines here, it's at the lowest levels not seen since, well, 2023 or so. So there's definitely a possibility that once we get more crucial information, maybe the next earnings season, maybe we get way more information, less uncertainty, you look at the data and you're saying, okay, all of these signs can point to a huge recovery. Or, of course, we can always go lower if things really get worse and worse. That's definitely a possibility. I personally don't see that happening just now. If the data changes, then the story will change as well. I mean, here as well, if you look at the long-short ratio, it's at the lowest point it has been since, well, look at this. Actually, it's lower than 24, 23, obviously 22, 21, even 2020. So the markets right now, especially when you look at the US markets, and you can see that in the underperformance compared to some European markets, the Chinese markets, we talked about this towards the end of 2024. Okay, this might make sense. Again, a couple of months of lots of uncertainties, tariffs, no tariffs, yes tariffs, changes in administration, changes in policies, DeepSeek, AI build-outs, data center leases being cancelled, yes or no, CoreWeave IPO, price is up, no, actually price is down. You have to take all of that into consideration, look at the bigger picture, and you're like, okay, Wall Street doesn't like all of this. And so this is what we get right now. For long-term investors, this period might be the best period that we've had in the last, well, since the last bear market. And remember, as we talked about this in the last video, the S&P had one of its fastest 10% correction in history. And yet, it's not COVID. You might say it might be trade war 2.0, the last time that did decrease in just 13 days. It's not an Eisenhower heart attack. It's not a Korean war. It's not the Volcker shock. It's not the Asian financial crisis. I always have to laugh at that name. No, it's not that. It's not that. And yet, this 10% correction is the 5th fastest. Now, if you don't think that this is an overreaction, then fine. Then I guess you think this is normal. I don't view this as a normal thing because I don't see the sky falling. Far from it. Currently, all of the data that we see, nowhere near any of these scenarios, right? Nowhere near any of these huge events. And if we look at the recovery afterwards, only COVID took a little bit longer, right? A month after that, it was still down 14.7%. But 3 months after that, we're already up. 6 months, we're up 15.6%. A year after that, we're up 27.9%. If we look at all of them together, 1 month later, the average, we're up 2.9%. 3 months later, we're up 8.2%. 6 months, 15%. 12 months, close to 20%. So again, yes, I do think that these are the types of periods where long-term investors should be taking the opportunity to buy and build up great positions. And as well, if we go back to what I said last week, and Tom has said that as well, since this is his video, Cuban Missile Crisis. The market did rebound already, start to recover, even before this whole crisis was over. So just like I said at the start of this video, with recessions, markets rebound before the recession is over. Markets rebound before a bad event is usually over. And last thing here, of course, just remember, if we look at the S&P 500 top 10 daily returns for the year 23, for the year 2024, you can see that those are the days that you really want to be in the market. Those are the days that you don't want to just, oh, actually the day before we were down, so I was panicking, I sold everything and I will be waiting for a rebound. Well, if you miss those top 10 days during a year, you are going to underperform the market by quite a lot, right? If you look at 2023, cumulative gains for just the best 10 days, 20%. Full year, best 10 days, only 4%. Same for 2024, the best 10 days, 19%. If you exclude the best 10 days during that year, it'll only be up 4%. So again, stay invested. Don't let headlines scare you out of positions. The best thing that I can think of for risk management is one, you can take profits, right? Nobody got poor by taking profits. And two, you increase your cash position, right? You can increase your cash position, and then in case things get worse, you can then increase your existing positions, or maybe if you find something interesting, you can open up another position, because guess what? The business did not change much, unless, of course, the whole business model is very negatively impacted by tariffs and things change. Rarely do we see these things right now, but these things exist. But with cash, with taking profits, you are, of course, de-risking yourself while still being in the market, and you will enjoy those 10 best days. And lastly, of course, things can change. The market is ever evolving, but for the long run, just like the trade war in 2018, I'm sure most of you don't even remember that happened at the end of 2018, right? So my best guess here is that 5-10 years from now, you won't even remember about this period at the start of 2025. You want to know why? Because if you zoom out and you look at all the other horrible events, way worse events that happened in the past, if you zoom out, you can see that the market has continued to go up and up and up. And that's the most important thing here. Be a long-term investor. Of course, short-term, if you're a trader, these are the best times for you, right? You can go up, you can go down, you can go up, you can go down in a matter of a couple of hours. You can make a lot of money, for sure. For long-term investors, I think you can find a lot of bargains in this market right now. Unfortunately, as we've seen in the previous bear market in 2022, retail gets scared when things go bad. I see this also in the data on YouTube. Sentiment changes, comments, viewership. People get scared like, oh, I will only buy when this goes lower. And yet when it was higher, you said you're going to buy when it dips. So which one is it, right? Oh, I'll buy the dip. And then the dip happens, you never buy. Yeah, human psychology, I guess. Anyways, that's what I wanted to say. I know there's a lot of, oh, it's over, game over, recession, fears. But I think if you look at the data, if you look at the big picture, we're far from Armageddon. Let's be honest here. So that's all I've got for you right now. Do share your thoughts and comments down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.